So we are about 3 years past the peak of the SPAC boom when all these blank check companies went public and started taking a lot of businesses onto the public markets for the first time. And we're going to revisit that in a little bit. Spoiler alert, in the most cases, it didn't work out too well. But in some cases it did. We're going to talk about four SPACs in particular. There are a few others, but four in particular that actually turned out to be pretty solid businesses because so many did not. Before we dive in, please take a minute, click subscribe to my channel. Check out the message you see on your screen. It's a link from our sponsor, The Motley Fool, fool.com/Frankel. You get the top 10 stocks to buy right now, and it's the best way to support this work I'm doing on YouTube. Again, the link is fool.com/Frankel. So let's talk about the SPAC boom of 2020, 2021. So in May 2021, there were over 400 blank check companies on the public market that were just sitting there with a pile of money looking for targets to take public. Obviously, there were not 400 private companies that wanted to go public this way that deserved to go public. So a lot of companies got taken public at ridiculous valuations, if we're being honest, that in a lot of cases that should not have been public companies. They weren't ready. A lot have since gone bankrupt. Some are trading for pennies on the dollar. And a lot just aren't making any money. Even if they're still in the market, some just have no real path to profitability. So back then, Warren Buffett issued a big warning, said SPACs are overpaying for businesses. He didn't like that they had to use their money within a certain amount of time. He thought the market was extremely crowded and there just weren't enough opportunities. And at the time, in May 2021, I said out of the 400 that were in the market, I think there were probably going to be about 10 good deals that were made where they actually took really good businesses to the public markets. Now, SPACs had been around forever, but they really got this boom when interest rates were extremely low. The pandemic had kind of created a lot of interest in the stock market, and there was a lot of just, just a general optimism in the market. So some of them actually turned into decent businesses. So I'm going to talk about four in particular, in no specific order, that actually became really good businesses, and in some cases actually made investors a lot of money. So the first one I'm going to talk about is one that I've mentioned before on this channel. It's called Sky Harbor. Ticker symbol is SKYH. This is a company that produces private aviation infrastructure, which is a big market need. Now, I know I don't have a private jet. Most people listening to this don't have a private jet, so you might not be familiar with how that world works. But the general idea is that one, more people have private jets now than have in years past. And two, the private jets that they're selling today are bigger on average than the private jets they were selling 10, 20, 30 years ago. These all need private hangar spaces. There aren't enough. And the ones that exist are pretty generic products. In a lot of cases, just basic, prefab buildings that you can pull a plane into. So Sky Harbor aims to kind of revolutionize this market. They lease space on airports through ground leases. They build kind of state-of-the-art hangar facilities with amenities like kitchens, with office spaces, with meeting rooms that are just, top-of-the-line products in the space, kind of what you would expect to have for your plane if you owned a $50 billion or $50 million private jet. Where would you want to park it? And they aim to be the answer to that question. So they went public by SPAC in early 2022. At the time, the company was essentially pre-revenue, but it had a lot of indicators of a good business. One, it had access to very attractive capital because they are public infrastructure. They're able to get financing through municipal bonds. That come with generally low interest rates and have very long terms. They don't have any debt due, I think, till like 2050 or something like that. Very, very long tailed, so they don't have to worry about refinancing debt anytime soon. They already had ground leases in place. The product was already kind of proven. They had a model up and running, I guess you would call it. They really ramped up the business in 2023. Revenue, quadrupled year over year, as the first three campus phases really reached full occupancy, or about 95% occupancy. It just signed ground leases in airports in San Jose and Orlando. It expects 3 more by the end of this year, 6 more by the end of 2025, and has the money to build out all of those right now. So, very solid business model. It just got a lot of interest from some big investors, including Palo Alto Network CEO, which called it a fantastic product. They have a lot of cash on hand, a lot of demand for this business, and they're still really just getting ramped up, so they're not profitable yet, but the economics of this business are fantastic. And at scale, this should be a very, very profitable type of business. The stock is reflecting that. For a SPAC, it's doing well. It's actually up from its $10 par value IPO price. Not by a ton, but it is trading at a premium to where it started. So it's a good business. Number 2 is DraftKings, DKNG, arguably the most successful SPAC of all time in terms of their returns for investors. There might be some that did a little better, but this is actually a really solid business. It started out at $10 a share, like most SPACs do. It's trading for about $45 a share as I'm talking. So the trend toward online sports betting and interest in online sports betting, it's not just toward the legalization, but more people are interested in sports betting than they were when DraftKings went public. It's now legal in 30 states plus DC. It's yet to break into the 3 largest states in the United States by population: California, Texas, and Florida. All 3 of them have ballot referendums, meaning that people are going to vote on legalization in 2025 or 2026. So that could be a nice growth tailwind as well. They've done a great job of reducing expenses while growing revenue. It grew its revenue at 44% last year and was able to reduce sales and marketing expenses by 16% at the same time. So it was profitable, nicely profitable on an adjusted EBITDA basis. They're guiding for a full year of adjusted EBITDA profitability in 2024 compared to a loss in 2023. It has over 7 million unique customers, added over 1 million of those in 2023 alone. Very strong trajectory of this business. It looks great. One of the best ones to go public by SPAC. The third one is one that I originally called one of the great SPACs. That it's not trading where it was when it started, but I'd still call it a solid business, and that's Opendoor. Ticker symbol is OPEN. Without a doubt, the most speculative of the 4 that I'm talking about here. Now, Opendoor is an iBuyer. Their goal is to simplify the real estate process by purchasing homes directly from sellers and selling them directly to buyers, with cutting out the middleman. The idea is it reduces a lot of the pain points involved with selling and buying homes, specifically having to hire a realtor, having to wait for offers, having to negotiate. You don't have to deal with any of that. You just get an offer, you sell the house. Now, Opendoor did really, really well in the 2021, 2022 years when the real estate market was kind of on fire. The market has slowed down considerably. The company ended up taking pretty big losses on a lot of the properties that it bought in that time frame, but it's kind of right-sized the business. It's gotten rid of the old book of business for the most part and is kind of up and running again in terms of growing the business. In the fourth quarter of 2023, Opendoor made almost 3,700 property acquisitions. That was up 17% year over year. It sold 2,364 homes, generated $870 million of revenue on that, and the margins are looking better. The margins from that, what they call the new book of business, the houses they bought after the real estate boom, the contribution margin was a little over 5%, which is pretty solid when you're talking about a product like a house. 8.3% gross margins. The company's adjusted EBITDA is still not positive, but it was much better than expected. They're spending a lot less on advertising now. One of the biggest things they've done is kind of pivoted to a partnership model to generate leads, specifically with companies like Zillow. They partner with RedfinRealtor.com and Lennar also. Acquisitions through partners are kind of going through the roof right now. They're up 140% since the first quarter of 2023. The Zillow partnership is live in 45 markets and has been very successful so far. And it's just looking like kind of a turnaround time right now. They could be one of the biggest beneficiaries as not only as interest rates fall and the real estate market picks up again, hopefully, but they could also be a big beneficiary of the kind of the National Association of Realtors lawsuit that's going on. It could save Opendoor money. Um, right now, they pay buyers agents because they kind of have to get on the MLS. That's not going to be the case anymore. So it could increase their margins significantly. So it's one that I like as a business. I'm watching it, but it's definitely a much better business than a lot of the other real estate businesses that went public by SPAC in that same time frame. And if I had to pick one that was going to be a long-term winner, it would probably be Opendoor. Last but certainly not least is SoFi, ticker symbol SOFI, one of my favorite investments in my portfolio. Not one of my largest, but one of my largest, what I would call a speculative investment. They went public by SPAC. They are trading for a little less than the $10 initial price. A lot of that's interest rate driven and just kind of speculation driven, was why it was overvalued when it went public as a SPAC, but it is a great business. In the fourth quarter of 2023, they achieved GAAP profitability, like bottom line net income for the first time, highest adjusted EBITDA ever, 30% adjusted margins. They now have over 7.5 million members. That's up 44% over the last year. It keeps growing very, very fast. Default rates are a bit of a concern. Their personal loan default rate is 4.8%. Their average interest rate on a personal loan is almost 14%. So it has a lot of room to absorb that, but definitely something to watch. That's a little higher than I'd like to see. The banking side of the business is doing great. SoFi became a bank in early 2022 and has grown its deposit base from zero to almost $19 billion as of the end of last year. That gives it a lot of cheaper capital to make loans with. Just for context, the average interest rate SoFi pays on deposits is 218 basis points lower than what it pays when it borrows money to fund its growth. Management's predicting 20 to 25% compound growth through at least 2026. And that assumes no new significant product launches that contribute money. They're projecting 55 cents to 80 cents of earnings per share in 2026, which based on today's stock price would be about a 10 times earnings multiple. So I think this one has a lot of room to the upside in the years ahead. Management's done a great job of executing, and that's why it's a big part of my portfolio. Hope you enjoyed that. I'd love to know what SPACs you still love and what you think of these four. Leave me any comments. I'll do my best to address each of them individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.